Hi everyone, welcome back to my channel. I'm Angela and today I'm going to walk you guys through a comprehensive map of finance careers. We're going to start with the left side of the map. This is the sell side. Sell side is called this because these firms are essentially selling investment ideas. They create and distribute financial products and often help raise capital for companies. Sell side is typically where many finance careers begin, especially out of undergrad or business schools. So firstly, let's talk about the investment bank. This is where the heart of the sell side is. Think of firms like Goldman Sachs, JP Morgan, Bank of America, Morgan Stanley, Citi. These banks offer a wide range of services to corporate and institutional clients. Let's break down the major verticals within the investment bank. So firstly, within an investment bank, you have the investment banking division. This is the high-intensity, deal-driven part of the bank, and you're advising companies on strategic transactions. Within your investment banking division, you have three sub-teams. You have your M&A team, your ECM and DCM teams, and your leveraged finance teams. Let's talk a little bit about each. So within your mergers and acquisitions team, your main function is to help companies buy or sell businesses. It's an advisory role. So for example, you would be advising Amazon on the acquisition of Whole Foods. Then you have your ECM and DCM teams. These are your equity capital markets and your debt capital markets teams. The main role of these teams is to help companies raise money by issuing equity or debt. So when a company goes public via an IPO, that's equity capital markets. And when a company needs to raise debt or some kind of term loan, that's called debt capital markets. Lastly, you have your leveraged finance teams. The main role of this team is to help structure loans and high-yield bonds to support M&A deals. So next, let's talk about some roles that sit on the opposite side of the investment banking division. These roles sit on the side of the so-called Chinese wall. This means that there's a strict separation between advising those clients and those trading securities to prevent conflicts of interest. So the first division on the right side of the Chinese wall are capital markets. This is where you're going to find your sales and trading and equity research components. Sales and trading is all about executing trades. You're buying and selling securities on behalf of clients or the bank itself. And now equity research involves analyzing publicly traded companies. For example, when you see in the news that Citibank is recommending that you buy X company for however much and they're recommending that you hold it, this is research that is done by an equity research analyst within an investment bank. Next, you have the risk management component of an investment bank. This group monitors the firm's exposure to different types of risks: market risk, credit risk, operational risk. They make sure that the bank isn't overexposed if, say, the stock market tanks or a borrower defaults, for example. You can think of the risk management team as the safety net of the investment bank. And last but not least, you have commercial lending. Commercial lending is perhaps the least flashy role of the roles within an investment bank. You can think of commercial lending as the ones that provide loans to businesses for working capital, expansion, or other needs. Next, let's talk about the middle of the map. This is corporate finance. This refers to finance roles inside of a company. These roles are part of a company's finance department. They're focused on managing the company's financial health, strategy, and reporting numbers. So let's start with corporate development. This role is a fairly common exit opportunity from investment banking because a lot of the work you do is quite similar. This team works on M&A from the company side and is basically the internal counterpart of a company to investment bankers. They evaluate potential acquisitions, partnerships, or divestitures. You'll see corporate development at larger companies like Google, Amazon, Meta, or just smaller companies that are more acquisitive, but typically only more mature companies will have a corporate development team. Secondly is your FP&A team, or financial planning and analysis. FP&A is all about budgeting, forecasting, and analyzing performance. If sales drop or costs spike, FP&A helps figure out why and advises the leadership. It's a great role for those who enjoy building Excel models and working closely with department heads. Next, and potentially one of the most common roles out there and one that every company needs, is accounting. This is where the numbers are tracked and reported. You've got teams that handle revenue recognition, cost accounting, and just ensuring that the company meets typical GAAP standards. Roles here are critical for closing the books and preparing earnings reports. Before jumping into working in corporate accounting, accounting, a lot of people will typically work at accounting firms like PwC, EY, Deloitte, or KPMG as launching pads into the field. And last but not least, investor relations. Investor relations communicates with shareholders, analysts, and potential investors. They help craft the company's story, especially during earnings season or big announcements. It's a cross-functional role involving finance, strategy, and communications. Now, last but not least, the right side of the map, the buy side. Buy-side opportunities are very often exit opportunities for those who come from the sell side. This is the world of institutional investors. These are firms that manage money by buying securities and assets. While the sell side provides investment opportunities, the buy side makes a decision of where to put that money. So firstly, let's talk about private markets. Instead of investing directly in a company's equity, these firms instead manage portfolios on behalf of institutions or high net worth individuals. This is the opaque, often more exclusive side of finance. The space is especially intriguing because investments are made in private companies which don't trade on public stock exchanges. These deals are typically less transparent. You're not going to find a public press release saying how much they spent on a transaction. They're less regulated and they're higher risk, but they have the potential for massive returns. Let's start with talking about private equity. This is probably one of the most common and most sought after exit opportunities from investment banking. This is where firms like Blackstone, KKR, Carlyle, and TPG play. Private equity firms raise large funds from institutional investors, pension funds, endowments, and insurance companies, and they use that capital to instead buy entire companies. The goal is to then improve the business operationally and financially, grow its value, and then exit an investment goal 5 to 7 years down the line and make a profit from it. For example, private equity firms might acquire a manufacturing company. They're going to streamline costs, upgrade the technology systems, replace the leadership, expand into new markets, then sell it 7 years later for a profit. It's a very hands-on process, and typically you're involved in the actual buying stage of the company and then the operationals of the day-to-day of improving that business. Next, let's talk about venture capital. So shift your mind for a moment from late-stage mature companies into startups. That's essentially the difference between private equity and venture capital. Venture capital firms like Sequoia, Andreessen Horowitz, First Round Capital, Excel, they invest in early-stage companies with high growth potential. These are often pre-profitable, they're higher risk, but the upside can be massive if you're able to invest in the next Airbnb, Stripe, or Figma. Winning in VC is often about being early and being able to back the right teams, because at that point, there aren't a lot of financials that you can take a look at, unlike in private equity. And lastly, private credit. This is perhaps a slightly lesser known field within private markets, but it's rapidly growing. Firms like Apollo or Golub Capital provide direct lending to companies, often more middle market businesses that aren't as big as an Apple but aren't as small as a Series A startup. Private credit fills a gap left by banks. These loans often fund acquisitions, growth initiatives, or just financing needs. In exchange, the private credit firm receives interest payments and often equity warrants or other upside potentials. Now let's take a look at public markets. This is where securities like stocks and bonds are bought and sold on exchanges. The public market is much more liquid, transparent, and regulated as a market, but it's also hyper-competitive as a result. Firstly, let's talk about hedge funds. These are firms like Citadel, Point72, Bridgewater. These firms pool capital from investors and deploy it using a wide range of sophisticated strategies. The goal is to ultimately generate alpha or just outperform market benchmarks. Popular strategies of hedge funds might include longing and shorting equity, so this means buying undervalued stocks while shorting overvalued ones. There are firms focused on macro strategies, so this means making big bets on currencies or interest rates or geopolitical trends. Hedge funds can be a very high risk, high reward type of role, and the top firms are known for their intense performance cultures and very data-driven strategies. Next, let's talk about proprietary trading. So unlike hedge funds, which trade using investors' capital, prop trading firms trade with their own capital instead of the client's money. Post-2008, the Volcker rule actually limited prop trading firms at traditional banks. However, prop trading, or just high frequency or quant-driven trading, however you might want to call it, still exists at firms like Jane Street, Jump Trading, or Hudson River Trading. These firms use speed, data, technology as their edge. You'll often find people who are PhDs in physics, math, or computer science running complex simulations or deploying trading algorithms measured in microseconds. The culture here at prop trading firms is oftentimes a little bit more like a tech startup rather than a Wall Street bank. The culture is a lot flatter, faster, and it's typically very hyper-efficient. Next, let's talk about the mutual fund. While hedge funds and prop trading firms chase an alpha, mutual funds focus more on broad access and long-term growth. These are firms like Fidelity or Vanguard, and they manage large portfolios across public equities and fixed income. You might be familiar with a lot of them if you invest in ETFs, for example, like Vanguard's VOO, which tracks the S&P 500. Next, let's talk about asset management. This is the broader umbrella that includes mutual funds, but also institutional portfolio management. These are firms like BlackRock, Invesco, State Street Global Advisors, and they manage portfolios for pension funds, endowments, governments, and corporations. These firms focus on long-term, risk-adjusted returns and often have dedicated teams for every asset class. Their assets under management can range from millions to even trillions. For example, BlackRock alone manages over $10 trillion, and it's the largest asset manager in the world. And last but not least, we have wealth management. Wealth management brings everything down to a more personal level. This is about serving high net worth individuals or families. This role tends to blend finance expertise with relationship management, and it's all about building long-term trust with clients and tailoring strategies to preserve and grow their wealth for generations to come. So now that we've gone through the entire comprehensive map of finance careers, let's talk about how they all connect. So firstly, starting off with investment banks. They sit at the center of the ecosystem and they act as intermediaries because investment banks are the middlemen. When a company wants to raise money or sell part of their business, they go to an investment bank. On the other side, you have the buy side. Firms like private equity, hedge funds, and venture capitals, these are often also the clients of investment banks. They rely on banks to find deals, raise capital, and help them invest in companies, whether they're public or they're private. Then there's corporate finance, the internal teams inside these companies. When a company wants to go through acquisitions or they need funding, these teams often work with investment banks to get it done. When they're selling a business unit or raising capital, they're usually talking to buy-side firms as potential investors or buyers. Finally, asset managers and wealth managers help deploy capital into all of these areas. So even though a lot of these finance career paths may seem separate and have their own functions, they're really all part of one cohesive system. It's all one big loop, and understanding how it all fits together will really help you figure out where you might want to plug in within this finance ecosystem. Let me know in the comments below which areas you want to dive deeper into. If you're thinking about transitioning from one role to another, I'd love to hear more about it. Don't forget to like and subscribe if this video was helpful to you, and I will see you in the next video.